China, with its massive population and important worldwide position. It has a prominent position in the global economic scene. They have the world's second-largest nominal GDP economy, a tribute to their fast progress over the last few decades. In 2022, their GDP will very certainly exceed $20 trillion. For the previous 20 years, its GDP growth rate has averaged roughly 6%–7% every year. This economic powerhouse is well known for its manufacturing capabilities, technological innovation, and various industries. They appears to be taking over the world industrial sector in the 2000s, thanks to abundant and inexpensive labor. They also manufactures over 30% of the world's electronics, consumer goods, and textiles. In PPP terms, China accounted 19% of world economy in 2022, and roughly 18% in GDP nominal terms. They are widely regarded as a worldwide trade powerhouse, with exports and imports accounting for a sizable portion of its GDP. It has a strong network of trading partners, which contributes to its status as the world's largest trading nation. Electronics, machinery, textiles, and other products are among their key exports. They also the world's top consumer of many commodities, accounting for over half of global metal consumption. As of 2020, China is the world's greatest beneficiary of foreign direct investment, with inflows totaling $163 billion. It has the second most outward foreign direct investment account, for $136 billion in 2019, after only Japan $226 billion. China ranked second in the world in terms of total number of billionaires as of 2022. According to Credit Suisse Group's 2019 Global Wealth Report, China has surpassed the United States in terms of wealth among world's population. China has the world's greatest foreign exchange reserves of $3.1 trillion. But when state-owned commercial banks' foreign assets are added, the value of China's reserves climbs to about $4 trillion. With stats like these, it's easy to see China continuing to grow and assuming world hegemony in a few years. However, the recent economic slowdown in China has frightened international leaders and investors. The Hang Seng Index in Hong Kong entered a bear market on Friday, having lost more than 20% from its last top in January. The Chinese yuan sank to its lowest level in 16 years, leading the central bank to launch its most aggressive currency defense ever, establishing a far higher rate to the dollar than the projected market value. The problem is that growth has slowed after a surge earlier this year following the easing of COVID lockdowns. Consumer prices are falling, the real estate crisis is worsening, and exports are declining. The government has ceased publishing data on youth unemployment because it has become so severe. Some projected that the jobless rate of young people would reach a new high of 21.3%. The fundamental cause of rising youth unemployment is a lack of demand from enterprises. On 2023, graduate in China stated that her class was passed over for career prospects because huge corporations were only searching for current students. To make matters worse, a major homebuilder and investment firm have both failed to make payments to their investors, reigniting fears that the continued deterioration of the housing market may lead to increased financial instability. A lack of decisive measures to encourage domestic demand, along with concerns about contagion, it has prompted a new round of growth downgrades, with some big investment banks dropping their expectations for China's economic growth to below 5%. Beijing has announced a slew of supportive policies aimed at reviving the real estate sector. However, even the stronger players are now on the verge of default, highlighting the difficulties Beijing confronts in containing the crisis. Meanwhile, it appears that loan defaults at property developers have spread to the country's $2.9 trillion investment trust industry. According to business disclosures from earlier this month, Zhongrong Trust, which managed $87 billion in funds for corporate clients and rich people, It has failed to refund a series of investment goods totaling $19 million to at least 4 organizations. According to footage shared on Chinese social media, angry protesters recently protested outside the trust company's office, demanding payouts on high-yield goods. Another major source of concern is local government debt, which has risen sharply as a result of the property collapse, as well as the lingering impact of the cost of imposing pandemic lockdowns. Local fiscal hardship not only poses significant dangers to Chinese banks, but also limits the government's capacity to stimulate economy and extend public services. Beijing has so far released a constant stream of economic stimulus measures, including interest rate cuts and other actions to support the property market and consumer firms, to mitigate the effects of the global financial crisis. Chinese officials unveiled a 4 trillion yuan $586 billion fiscal plan. However, the policies, which were aimed at government-led infrastructure projects, resulted in extraordinary credit expansion and a significant increase in local government debt, from which the economy is still recovering. Furthermore, China faces long-term concerns such as a demographic crisis. As a result, China's fertility rate is currently lower than that of Japan, a country long known for its aging society. China released figures earlier this year showing that its population, they began to decline last year for the first time in 6 decades. A decrease in labor supply, along with rising healthcare and social spending, could result in a larger fiscal deficit and a heavier debt burden. A smaller workforce may also reduce domestic savings, leading to higher interest rates and lower investment. So, what do you think? Will China economy grow like 2000's decade? Or they will plunge into crisis? We have to wait and see, and hope for the best.